This is the second video of the Smart Start and YoungBIZ collaboration. Today we will be going over managing credit, debit, and debt. Money in your wallet used to mean cash, but today we use credit cards, debit cards, and loans to manage our finances. This shift is not just a passing trend, but a transformation that impacts how we interact with money on a daily basis. With a credit card, you can borrow money within a limit and pay it back later with interest. Credit scores are a numerical representation of your credit worthiness. Short-term credit is used for purchases or emergencies, typically paid off within a month. So, credit allows you to access money you don't currently have, but it comes with the responsibility of having to pay it off in time. What is debit? Debit refers to money that is withdrawn directly from your bank account, typically using a debit card or through other banking methods like online transfers. Unlike credit, you're using your own money instead of borrowing funds. Debit cards allow you to make purchases or withdraw cash directly from your checking or savings account. When you swipe a debit card, the funds are immediately deducted from your account, which means you can only spend what you have available. Debit transactions are usually processed in real time, meaning that when you make a purchase, the money is deducted from your account right away. This makes it easier to track your spending and ensures you don't accumulate debt, since you can't spend more than what's in your account. Loans are a common way people incur debt. They can be used for a variety of purposes, like buying a home, paying for education, or financing a car. When you take out a loan, you borrow a specific amount of money, which you then repay over time, often with interest. The terms of the loan, including the repayment period and interest rate, can vary based on the type of loan and your credit worthiness. This is the main way that people incur debt, and some types of loans are student loans, mortgages, and personal loans. Interest rates are the cost lenders charge for allowing you to borrow money. They are usually expressed as an annual percentage rate, or APR. Higher interest rates means you will pay more for borrowing the same amount of money. For example, credit cards often carry high interest rates, while mortgages tend to have lower rates. The key takeaway here is that the higher the interest rate, the more expensive the debt becomes over time. Not all debt is created equal. There's a distinction between good debt and bad debt. Good debt is often considered an investment that can help you build wealth or improve your financial situation in the long term, such as a mortgage or a student loan. Bad debt, on the other hand, typically comes from borrowing money for consumption or non-essential purchases, like credit card debt or payday loans. Bad debt can quickly accumulate and become difficult to repay, making it a risk to your financial health. Some debts, like a mortgage, may be considered good because they help you build wealth, while others, like credit card debt, can be damaging for your finances. So, debt isn't inherently bad, but it needs to be managed wisely. Too much can quickly spiral into a financial burden. How credit score affects your financial future. Your credit score can affect everything from loan approvals to housing opportunities, insurance rates, and even job applications. Your FICO, or credit score, is a range between 300 to 850 points that is influenced by several key factors. Payment history, worth 35%, is the most significant, with on-time payments improving your score and late payments causing long-term damage. Amount owed, worth 30%, or credit utilization, reflects how much of your available credit you are using. Keeping it below 30% is ideal for a positive score. Length of credit history, worth 15%, benefits from older accounts, as it shows your ability to manage credit over time. New credit, worth 10%, involves recent inquiries. Frequent applications can temporarily lower your score, so it's best to limit them. Finally, credit mix, worth 10%, looks at the variety of credit accounts you have, with a mix of revolving and installment accounts being preferable. The dangers of exponentially growing debt. debt can quickly become detrimental to your finances, especially when high interest rates are involved. Credit cards and payday loans, for example, often charge high interest, which can cause your debt to grow rapidly if not paid off in full each month. Additionally, paying only the minimum payment on a credit card or loan prolongs the repayment period, leading to more interest charges and a longer path to becoming debt-free. Without a repayment strategy, debt can snowball, where missed payments or partial payments cause interest and fees to accumulate, making it harder to catch up. Small amounts of debt can quickly spiral out of control, creating exponential growth, where your original debt increases significantly due to added fees and higher interest rates. The key takeaway is that unmanaged debt can become overwhelming, but with a solid repayment plan, you can avoid falling into this cycle. Now, to recap, we went over how credit can be utilized to purchase items within your credit limit and pay the dues at the end of the month. It requires responsible spending, as credit debt can be very detrimental to your finances. Debit can be utilized to remotely access your money wherever you go, typically in the form of a debit card. Debt and loans can be utilized in moderation to help you purchase assets. It is only beneficial to take a big loan to purchase appreciating assets. If you like this video, you can access more content through the links below. Thank you.